Well, good morning, everyone. My name is Matthew Mims, and on behalf of Devon Funds and the Investment Store, I'm delighted to welcome you to our latest investment briefing. So in today's briefing, Devon Portfolio Manager Nick Dravitzki will provide some topical commentary on local equity markets and also comment on a few key stock holdings within the various Devon Australasian equity portfolios. The session's going to last for about 15 minutes, and we will leave a few moments for questions at the end, and please do send these in as we go through using the questions box. And thanks also to those who have already sent questions in. As ever, please note that the information in this presentation is of a general nature and should not be taken as financial advice to purchase or sell a financial product. So I now would like to pass you over to Nick.
Thanks very much, Matt, and good morning, everybody. Thanks for tuning in to this month's webinar. So this time of year, April, we're sort of between reporting seasons, so on the face of it, it's a slightly quieter time of year, but we've been very busy running around meeting companies and doing some travelling to really look for some ideas to put in the portfolios. And so what I'm going to talk to you about today is some of those ideas and some of the things that we've been thinking about recently. Just before I do that, I'll just touch on performance, which is on slide 2. So long-term performance is very strong. Recent performance has been a little bit weaker. There's a number of reasons for that. Partly it depends across the funds. Some of the funds, obviously for alpha, there's a high cash weighting. There has been a high cash weighting over recent times, and that has dragged down that performance relative to indices. In the dividend yield fund, there has been obviously there's been some clear move against higher yielding stocks across the market, and broadly we have had some of our individual stock selections have not worked out as we may have desired. Particularly some of the stronger positions that have given us great performance over the medium and longer term have not done so in recent times. The key thing I want to emphasise here is that the process that we follow is one that we firmly believe in. We are very focused on valuation. We are very focused on understanding businesses at a fundamental level and modelling them, understanding their cash flows, valuing those cash flows, focusing on quality, and populating our portfolios from that process. And at times that will result in portfolios that may differ from overall market performance, but we have strong conviction that it is the appropriate way to invest, as over the medium and longer term it provides clients with strong outcomes. And that process really drives everything we do, and we think about that in relation to some of the macro situation that we face in the world at the moment. Global geopolitical risks are ever present, but they seem higher now perhaps than they have been in recent times with the advent of the new president. Now, and as ever, there will be many of these risks to worry about. Presently, of course, we have North Korea, we have Syria, we have heightened conflict, heightened tensions between the US and Russia. We have elections coming up in France and Germany this year, and no doubt there will be many others that arise. The key point I want to emphasise here is that the vast majority of these risks, while they may affect markets in the short term, will have very limited impact on the underlying earnings of the businesses that we are interested in investing in, and our process and focus will remain on those underlying earnings and populating our portfolios in that manner. Underneath those risks and putting them to one side, it's worth noting that the global economic conditions continue to bubble along reasonably nicely. The US continues to demonstrate reasonably strong economic growth. More pleasingly, Europe has continued to generate some surprisingly good economic growth numbers, and so for the first time in really many years, synchronized global growth is actually looking more attractive than it has before. And so, and the other big contributor to that is China, and there's a couple of charts there on slide 4 which really emphasise the rebound in China's economic growth over the last year. Tama was in China last month. He travelled around and spoke to many companies, toured some coal mining regions, and clearly the evidence of economic activity picking up in China remains very strong. And the chart on the left there really indicates how strong that rebound in nominal GDP growth has been. That driver of that nominal growth has been the pickup in inflation and producer price inflation in China, which has really helped to strengthen that headline number. But underlying real GDP growth has clearly picked up a bit. What's striking about that is in the chart on the right, is it's really China doing the same old thing, and that's investing in infrastructure to stimulate economic growth. And that real rebound in infrastructure, which is also spread a little bit to property in particular, has really been the key driver behind that strong pickup in Chinese growth, and that's clearly had some positive effects on global GDP growth as a whole. Obviously, the risks around that remain. The debt levels in China continue to be unsustainable, and when you have GDP growing at 6 or 7%, and the debt burden growing at debt to GDP growing at 12 to 13%, then you clearly you're storing up risks for the future. But for the time being, the Chinese economy still seems to be benefiting from that approach, and the day of reckoning is very hard to predict. Turning closer to home, if we look at Australasian share markets, you can see that valuations remain high, but they aren't generally extreme. So looking at the New Zealand market, the PE there is around about just under 20% higher than its long-term average. Relative to its 5-year average, it's in high single-digit percentages, the premium. In Australia, you're looking at a similar high single-digit, low double-digit premium if you strip out resources from the main Australian index. Resources, because you've seen those commodity prices bounce so hard and you've seen a lot of upgrades come through, are now on low price to earnings multiples. So taking those out, you see that the market is more expensive than it looks with them in. But while markets are expensive, they aren't at the kind of extremes that we've seen in the past. Clearly, it makes our job in finding stocks that we find attractively valued more difficult, but it isn't at a level that is as worrying as it has been previously. Turning to probably a more extreme example of valuation in the local market is the risk around housing, and it's interesting how much comment and commentary there has been around this both in New Zealand and Australia. The chart on the left was produced by The Economist a couple of months ago, and clearly indicates New Zealand as an outlier, even in a world of significant house inflation. The chart on the right really focuses on where the Reserve Bank of Australia is starting to address their concerns, and that is on the very large share of residential mortgage lending that is interest only. And so what you can see there is that interest only lending as a proportion of all lending across the Australian residential mortgage sector is around 40%. Of investors, you will see that 60% of investor lending is at interest only, and perhaps more interestingly, 20% of owner occupiers are borrowing at an interest only way. The striking thing about that is that presumably you're borrowing interest only if that's the only way you can afford to be purchasing a house. So it does seem to present considerably more risks than a principal and interest structure. The other thing to bear in mind is that with interest rates at a much lower level, if borrowers are required to step up from interest only to principal and interest, then you have a very large step up in your payment. So at a 4.5% interest rate, if you move to a principal and interest payment, then you're looking at a 70% step up on a 25-year mortgage in the ongoing payments. And so these are the reasons that the RBA and the RBNZ are increasingly focused on those risks, and clearly their interest and concern and the steps that they are taking to try and manage that are becoming more material. So that's a bit about the broader macro environment. As I mentioned earlier, we've been travelling around, visiting companies, travelling around New Zealand and Australia, and really doing what we do, which is try and find as many good ideas as we can to invest in. We've made a number of changes and additions to the portfolios over recent times, and so I thought I'd talk about a couple of those. Just on the travelling, we have a couple of key holdings which have significant US businesses, and so next week Tara and I will be travelling up to the US to do a research trip, really focusing on those and a number of other relevant issues in the US market that apply to Australia and New Zealand. And so we'll talk more about that perhaps next month when we're back from the trip. So turning to a couple of these additions, we added Brambles to portfolios last week. So Brambles is really an excellent example of a blue chip business that has seen some short-term concerns and really seen its price sold far below what seems like fair value to us. So Brambles is a pallet pooling business. It used to own Recall, the document storage business, but now it's a pretty much a pure play pallet pooling and container business. And so what that means is it produces primarily the wooden pallets that are used in FMCG and large retailers largely, and they work on a pooled system where they pay Brambles an annuity essentially to provide and maintain the pallets that they use within their supply chain. It has very attractive drivers underlying the business in that the economics for larger entities of pallet pooling are significantly more attractive than doing it yourself, what they call whitewood. And as a consequence, there is a significant, very significant addressable market that Brambles operates in. The label of their pallet pooling solution is CHEP, and it is the largest in the world and has continued over the years to continue to penetrate further and further into these markets, but there is still very significant scope for them to expand. In recent times, the share price has been hit by a couple of things. In the first half of the 2017 financial year, so second half of last year, 2016, they saw weakness in the US, really driven by a little bit of destocking from some retailers and from some competition from the whitewood pallet suppliers. But perhaps more importantly, you saw a CEO change, and the new CEO stepped back from the explicit return on invested capital targets that the previous CEO had in place. And the market reacted fairly savagely to those developments, and the stock has sold off around 30% from its peaks late last year. Our view is that the issues in the US are cyclical and will be Brambles will see recovery from that. And on the ROIC targets issue, while it's always nice to see a company focusing on achieving rational and achievable goals, clearly a business like Brambles should be focused on doing the most efficient thing it can to grow revenue, and if that involves having a slightly lower return on invested capital, then that may well be the right thing to do. So the withdrawal of those targets in and of itself doesn't necessarily seem to me to be a major negative on the face of it. Strikingly, Brambles has got down to the level where it's a discount to the industrial sector as a whole, the industrials market as a whole, which hasn't happened since 2009 when it had some very challenging company-specific and industry-specific issues to deal with. So that's why we added to it. As of yesterday, Brambles released its first quarter trading update, which, while not particularly strong, was clearly received positively by the market, and the stock bounced 6% yesterday. But we'll continue to hold it as we like it and consider it to still have attractive valuation. The next stock I wanted to touch on was Westfield, which was added to Alpha last week also. Westfield is a company that you'll be familiar with. It used to be a half shareholder of the Westfield malls around New Zealand and Australia. Now it's exclusively focused on the malls in the United States and the UK and development opportunities in Europe. and it is has a very long-standing track record of being the premium shopping mall developer in the world. The striking thing about it at the moment is that you've seen a sustained period where, due to bond yields rising and delays in earnings coming through from some of their developments, and that's partly a consequence of the developments taking longer to ramp up than anticipated, but also because they've sold some of their lower quality, higher yielding malls, the market has become a little bit impatient with earnings growth, and you've seen the stock sell off very significantly. What you're now looking at is a business which yields around 4%, 4% dividend yield. It has funds from operations growing through next year and years beyond in the high single digits. That won't translate exactly to dividend because the payout ratio will come down a bit, but underlying earnings will grow substantially. And you are paying it at a premium to NTA, which is essentially only values the work it has in completion by the end of next year. Beyond that, it has a very significant, very significant pipeline of very high quality developments. It has a fantastic track record of building these developments on initial yields of around 7.5%, at which point they are valued up to around a 5% cap rate. So its ability to create meaningful value from its development pipeline is extremely high, and at current prices, it's an excellent opportunity. The last stock I wanted to touch on that has also been added to Alpha is Henderson. Tava's talked about Henderson before. Henderson is a funds management business based in the United Kingdom that is merging with a US-based funds management business called Janus. And very much the attraction here is that the merger will result in a much more diversified, much more attractive business. There's material synergy opportunities from putting the two businesses together, and even those synergy benefits, putting the two businesses together as they are, it still would be priced at a lower multiple than the broader US asset manager market. So for all of those reasons, we think it's an attractive holding to add to the funds. So that's really what I wanted to go through today. Just to summarise, while we are faced with many risks, and we clearly overall markets are not cheap, there does seem to be, given some of the volatility we've seen in recent times, there seems to be some interesting opportunities around, and it's good to be able to talk about some of the ones that we've been putting into portfolios. Very happy to take any questions.
So we've probably got time for 2 or 3 questions, Nick. Maybe just the first one here just relates to Fletcher Building. I don't know if you could just comment on its recent woes and outlook.
Sure. So Fletcher Building, following its first half result in February, where it released a slightly disappointing result, most of the underlying business was okay, but it had a write-down for one of the projects in its construction sector. But much more disappointingly, 3 weeks later, it made another trading update where it had a much more significant write-down across that project and a number of others. So it clearly raised questions about the visibility that management have over the risks in that construction book, and the clear question of how much more is there to go. So the answer is that it's, from our point of view, is that it's probably impossible to know. The company has been very explicit that they think that they put enough fat around their assumptions, that they won't see further write-downs affecting their earnings. In the meantime, the rest of the business is moving along at a reasonable rate. I think that from a valuation point of view, it looks reasonably attractive if there are no further write-downs. And so for that reason, it continues to be a holding in the dividend yield fund. It has a very attractive dividend, but one needs to be very cautious around potential further risks. There's another question here. Do we have a view on the Oceania IPO? Yes, we looked at it. We haven't participated in the IPO. There appears there's been very strong uptake from retail investors, so which obviously bodes well for the performance of the stock post-listing. Fundamentally, the issue with Oceania, from our point of view, is that it is a relative to the rest of the sector, it doesn't present compelling opportunity. It's essentially valued at its book value. MetLife Care is also valued at its book value and is a much larger and more attractive business than Oceania. Oceania has projected very, very strong profit growth, which, if they achieve it, will clearly be a positive. Most of that profit growth comes from development margin, so the profits they account that they will make on the developments that they are undertaking over the 2018 year. There is a number of risks around development margin, primarily how you actually allocate development margin when you're building a facility that has a village that has a number of common facilities is a perennial issue. And we've talked about that with the company during the IPO process. But in general, it's not the highest quality earnings growth that you can have. And so for those reasons, and given that across the firm and across the funds we have significant position in MetLife Care, we didn't participate.
Okay, so final question, Nick, just in regards to the Alpha Fund, maybe just a comment on the current cash position, whether it's likely to go up or down. Just a final question also on what dictates your decision to invest in the stock versus cash within the Alpha Fund.
Sure, so the Alpha Fund process is very much stock driven, so as we find ideas that we have high conviction in, then we include them in the fund. If we don't find those ideas, then we hold cash. Currently the cash level is around 30%. That's a little bit lower than it was a couple of weeks ago, a month ago, and that's because of investments in Westfield, Henderson and Brambles. The position in National Australia Bank has been reduced significantly. But still a reasonably high cash level at around 30%.
Okay, well I think we've probably used up all our time. So many thanks to everyone for taking the time to listen in today. And thanks also to Nick for preparing the material. We will send a follow-up note, including a copy of the slides and recording of the session to you a little later on. If you do have any further questions, then please obviously feel free to contact myself or Devon directly. So on that note, many thanks once again and have a good day.